listening to Shut Up and Invest.
Welcome to another episode of Shut Up and Invest. I got Jay Money in the house. What's up, Jay?
Doing good, man. Doing good. Another episode of Shut Up and Invest. My boy Kevin in here. Looking nice today. I like that.
You know, we had some money meetings.
I had to put the money suit on.
If you see me like in shorts and a t-shirt, it's because it's the weekend.
Yes.
But
yes. Now, me, I'm in shorts and t-shirts usually every day of the week. But sometimes I had a meeting today too, so that does make sense. But you got to meet,
I like
more formal settings sometimes.
I'm like two extremes. I like a good suit.
I feel you.
I feel like, like when Superman puts on his cape, when I put on a suit and I go out there to go make money, it does feel good. It makes me feel...
It does feel good.
But if you do not see me in a suit, you will see me in a t-shirt and a hat.
Yeah.
I'm the two extremes.
You are definitely.
I don't want to be... I will either suit up or I will suit down.
The good thing about real estate investing is you can do whatever you want most of the time.
Yeah.
Like when you're really just investing, you can do... some of the guys who I have the most homes I've ever met have pulled up in the minivan and, some sandals, pair of shorts, and a tank top, and they own 200-300
I read
homes.
something like Warren Buffett still drives around his old school ride.
I think it's a Buick or something like that. Yeah, he does. And the same house he bought, I think, in like the 80s.
Yeah.
Don't judge a book by a cover, man. That's especially in this, Like, a lot of guys are moving undercover, doing a lot of stuff, and they're not worried about the glitz and the glamour and the social media fame. So,
yeah,
but you do look good today. Just want to tell you that.
I appreciate it, bro. I'll give you a shout out to Jen Rowe, my tailor. If you guys want a little good suit, talk to Tim Beasley out there. Let him know Kevin sent you. Shout out to Jen Rowe.
So that's kind of a segue though about talking about being your own bank. A new segment we're gonna do is about being your own bank. And when you are your own bank, it doesn't matter. You can wear whatever you want, right? Because you control the bag. You're creating the income.
And I think what the biggest thing here is it's about passive income.
Passive.
I know we talk about it a lot, and that's a big thing about real estate investing. Mm-hmm. And when you talk about real estate investing, it's about letting your money make money for you instead of you having to punch in, punch out, and grind. Now, we punch in and punch out to create more money to be able to then invest it to create more passive income.
Exactly. That's
to the point that the passive income reaches the goal, and then
we can punch in and punch out a little less.
A lot less.
Because you know how we are. We're going to still be doing this stuff, but a lot less than what we have to because, I just left a meeting today about assisted living facilities. That's a true passive income business, right?
If you got the right operator.
Yeah, definitely. We're going to talk about some seller financing real estate notes today. That can be passive income. Multifamilies, passive income. If they're ran right, it is truly passive, right? You don't have to be in the day-to-day.
Yeah.
When you wholesale, which we both do, again, we're doing that to create income to buy assets that will give us passive income. That's a grind, Even the guys who might have a big operation that's on, automated and stuff, it's still going to be a grind.
Like every industry, right? Being in this industry, being a realtor, going out, finding buyers, finding sellers, making the deal happen, getting a closing, making that nice little check, that's a grind. You got to do it day in, day out, year after year. It's not passive income.
No.
Closing loans, same thing. So if you're in the real estate and you're a loan officer or you're a private money lender, you're out there finding this and that and brokering the deals. That's not passive income unless you're lending your own money, and now you're being the bank.
Now you're the bank.
If you're flipping properties,
that's active.
That's still
that's not
passive income. It's a nice little chunk of change when you flip the property for a good profit, but then you got to find the next one, and you got to do it year after year after year. So this is the first of many Be Your Own Bank segments.
Mm-hmm, definitely.
And I think today we're going to concentrate on kind of combining two things that we've been talking about, right? Wholesaling, but instead of wholesaling the property, we're going to talk about wholesaling the actual note, which means the loan.
Yep.
And how that can open you up to a wider variety of buyers and what kind of buyers want to buy what we call a note or the mortgage or the loan. Those are all basically the same thing.
Yeah. Yeah, this one actually is kind of combining the wholesaler and the note holder, right?
The bank.
The bank, right? We're going to combine how, I'm going to tell you how I actually wholesale seller financing deals, right? So it's going to combine the wholesaler who's doing his wholesaling deal and that guy. What's the guy who wants to hold the note, right? The bank. What is his thought process of what makes sense for him? Because we're doing both. We want to be on both. We're going to kind of break down the whole process and show you the ins and outs of that.
All right, perfect. So obviously you can go back to previous episodes and know what wholesaling is and whatnot. But if you just joined us and you're a first-time listener, first of all, what's up, man? Where you been?
What took you so long?
For real. If you haven't heard,
the hottest podcast out. Shut up with the best.
Wholesaling or acquiring a property, essentially, you're finding a great deal, a motivated seller. You got a great deal under contract. You put it under contract, and now you're looking to sell the deal. Traditional wholesaling is you're literally flipping the contract. You're selling that deal, that opportunity, that contract over to someone that wants to keep it and be the investor on the deal, whether they're going to flip the property or they're going to rent the property. And that's kind of the traditional wholesale model. Mm-hmm. Now, to open yourself up to a bigger buyer's pool, you can go ahead and turn around and wholesale it when it's completely done, meaning you already sold it to someone else. You wrapped up your own terms. You created a loan. You created a note on a seller financing deal. And now you're selling that loan. So let's break that down.
Definitely. So in this process, again, it starts with the wholesale deal, right? The marketing is still the wholesale deal. We market for wholesale deals because we want to evaluate that deal in different ways, right? So being able to have these seller financing buyers allows you to take on more deals that might not make sense, in the traditional wholesale process.
For someone who wants to fix and flip.
You're stuck with ARVs and stuff like that. This is different, right? So, let's use an example. This is a real deal. We sent out some direct mail campaigns. We negotiated on the house. The seller came back $18,000, right?
That's what the seller wanted
for the deal, right? So me and the seller agreed to go into contract with me paying $18,000 for that house, right? When I get that on the contract,
where was this property?
This is in Kalamazoo, Michigan.
Okay,
all right. Me personally, I evaluate every deal I tie up on the contract in 4 different ways, right? Do I just wholesale it, right? Or do I basically buy it myself, right? And as a buy and hold? Or do I go to the seller and see if the seller will do seller financing for me to buy it from him? Well, he'll give me seller financing terms.
He'll be the bank. He's the bank.
Yep, he'll be the bank, right? So he's the bank. He's going to hold it for me. So that means I can get into that property for probably 10%. If it's a lower number.
Give him a little bit of cash, and then you pay him monthly payments
per month.
Instead of a tenant, and he's the landlord, he now becomes the bank because technically he might not owe anything on the property usually when you're doing these deals.
Yep.
And then you're paying him. However, you're the owner of the property now, and he has become the bank. So that's one way of becoming the bank.
Definitely. He's the bank. If you
own the property.
Yeah, he's the bank. I'm the owner. He's financing me the property, right? If I'm trying to buy and hold some deals that I want to own, I can go about it that way. Hey, Mr. Seller, will you take 10% and I pay you this amount per month over 3 years, right? That's the way for me to own that house, right? Now I own the asset. I can do what I want the asset for a lot lesser amount of money than for paying the cash up front, right? So I look at that first because I'm trying to own. I'm trying to own as much as I can, right? So I always ask them, will you take seller financing? Right. Another thing that I'm doing now a lot is I'm locking up on my wholesale contract, and then I'm saying, how much can I get if I sell this on seller financing to a buyer? Right. Because I know a cash buyer might pay $30,000 for that $18,000 house that I have on the contract. Right. But a seller financing buyer might pay $50,000 with $5,000 down for that same house. Got it? So my thing is now is, okay, what can I sell that for on seller financing terms to somebody else? So this particular deal, we got in the contract for $18,000, and then we ended up selling the property for $50,000, and we had them put $4,000 down, right? So I found an end buyer who would say, hey, Jorie, I'll buy that house for you as is. You don't have to touch the house for $50,000, and I'm gonna give you $4,000 down, and we're gonna do a 10% interest over 7 years.
Okay, so let's
break that down.
Let's break this down for a second. in a traditional wholesale deal, I could have probably flipped that property at, you got it for 18, anywhere between 25, maybe $30,000 on a good wholesale.
Yeah.
In this scenario, you are also marketing not just to find the seller who wants to sell it to you for 18,000. You've done a separate marketing campaign and built separate relationships with people out there that are willing to buy the property and are looking for the seller of the property to offer them terms.
Seller financing or land contract terms. Yeah.
Right. So
I built a database of seller financing buyers, right?
Correct.
So in my CRM, when you go to my Carrot site, it asks you certain questions. Are you a cash buyer? Or are you looking for a place to live? Are you looking to buy it on seller financing, right? So I have lists in there where I can go to my seller financing buyer list, and there might be 300 people in there looking for those kind of deals.
Right. So you have a nice little list of people that have raised their hand and said, I love to be able to buy properties, just like you said. I prefer seller financing. And here's why, some of the reasons why you'll have a lot of buyers out there and a lot of investors that prefer seller financing. You can do the deals fast. Mm-hmm. You don't have to jump through the hoops that the banks create for you. You may not be claiming all your income in the eyes of the IRS. I know it sounds crazy, but there's actually people out there that are not telling Uncle Sam all the money that they're making, which means if they turn in tax returns to a bank to qualify for the loan, they're not going to get approved.
Because their income's less than what? They're showing a lot less income.
It's showing a lot less income on their tax returns. Now, I personally don't do that. And neither does Jay Money, because we're abiding citizens.
But it happens.
And we're cool with Uncle Sam. But in this country, there's a couple people out there that may not be reporting all their income and don't want to pay the taxes on it. But guess what? They have no problem putting 5, 10, 15, 20% down on a property. So in a situation like that,
this is very, very appealing to them.
Which is a lot of common people. These are the same people that are looking for private money deals as well.
Also, what about the guy, the investor who has like 8 or 9 loans already in his personal name? There's a limit on it. There's a limit on how many you can get conventional financing.
Yeah, there's a lot of, and conventional financing is 10. Then you have your portfolio lenders, and then each one of them create their own guidelines. Usually it's about another 10. Once you start getting to somebody that owns 20 plus properties, banks there's very specialty style banks that will look at you. Most other banks will say, I'm out.
Got it.
So to avoid all that headache, if you're offering me this particular deal at $50,000, I only have to put $4,000 down plus whatever the closing costs are. So I get a loan essentially from you, who currently now owns the property, for $46,000.
Got it.
That's where we're at right now.
That's where we're at. So now remember this, we're talking about wholesaling this deal. So I have it under contract for $18,000.
Yeah, you haven't technically closed.
I haven't even closed yet. I have it under contract.
And paid the seller the $18,000 that you originally acquired the contract for. But so now you have two people. You have the original seller who wants 18, and then now you have a buyer who wants to buy it at 50, but he's only giving you 4,000.
Exactly. And yeah, he's giving me 4,000 down, right?
Okay.
So
you still got to come up with $14,000.
Exactly. The key to it is, though, I control the deal now, though, right? Because I locked up in a contract, I can go out there and do what I need to do. And if you're creative, there's more things to do than just wholesale that for the $8,000 assignment fee, right? I'm just like, we could just wholesale this for $26,000, walk away with $8,000, right? What I've been doing a lot is, let's go another step, right? Let's find that end buyer we just talked about, right? So right now we have a contract that I have. This is a written contract between me and this end buyer with those terms. Then I go and find another party who wants to hold that note, right?
So you're juggling two contracts on each end, a buying one and a selling one.
Yep.
And now you find someone who wants to be the bank.
Who wants to be the bank, definitely.
Who likes those terms you just negotiated of a $46,000 loan at what interest rate?
At 10% interest over 7 years.
Okay, so for the next 7 years, I'm going to get 10% interest on $46,000.
Exactly.
Now, if I got $46,000 and it's in my 401k, I may not be making that interest rate.
You're probably not making 10%.
I'm probably making 3 to 4% if I'm in a good one. There's some people out there making 1.5 or 2 after you take out the fees and everything. I may have $50,000 sitting in my savings account. I just had that conversation today with my old business partner, and before the market crashed, and he was talking about investing and whatnot. He's like, man, I'm letting money stack up. And I need to start making this move because I'm spending more than I should be in my day-to-day because the more that keeps going in the bank account, the more easy I whip out the credit card. And I was having the conversation with him as like, dude, I just keep 6 months of reserves that pays my bills and my bank account. Everything above 6 months, I need to invest it.
Definitely. I told somebody that today, like, my stepdad actually, he has a large 401k. I'm like, listen, you need to invest that now. A lot of people want to hold on to cash, right? Cash is manipulated. It's devalued. Like our dollar loses its value a lot, especially in South America. They know that's why they invest so much because it's not safe sometimes, right? You want to be less cash heavy and be more cash flow heavy. Right?
Yeah, exactly. So in this case, I'm thinking, okay, you know what? 10% on 46,000. That's a nice little return on investment that I'm not getting in my savings account and I'm not getting in my 401k or my IRA. Okay, I like this deal. I'm in it. So now let's negotiate. I'm interested. Now what?
So another benefit to you, Kevin, the guy who wants to buy the note, is this. I'm going to probably sell you that note for 90% of value, right? If you want to pay 100%, great. But most of my note buyers, I know most of the ones you know too, they want a little bit of discount on that note, right? So we're at 46 and they're going to I'm going to say, hey, look, I'll offer to you for 90% of value. Okay. So now they're going to probably pay what's 90% of 46. You figure
let's call it 40.
40, right? They're going to pay $40,000 cash for a $46,000 note at 10% interest, right? So their actual return is going to probably be around 11, 12 because of that difference from the 40 to the 46.
Right off the bat, now you're telling me I can buy this mortgage, this loan, have $46,000 and 10% interest rate for the next 7 years for only $40,000. The reason why we discount it, not just to make it more attractive, but if for whatever reason the guy who's buying the property and agreeing to these mortgage terms sells the property the day of tomorrow or refinances the property 6 months later, you're guaranteed already at least $6,000, $7,000 of profit in a short period of time.
Yeah, because remember, you own the mortgage note. The person who's buying the home, so the financing owns the house. They can sell it, do whatever they want with it. So if they were to sell it, like you said, in a week, you're going to still get that right there.
Right. So
Plus.
Which is not a bad deal. If I put 40 and 2 months later, the guy refinances or sells it for whatever reason, changes his mind, changes his plans, and I walk away with $6,000 in literally, 60 days. Hey, keep it moving.
Yeah, keep it moving. On to the next one, right?
Yeah, beautiful. Can you send me another deal like that?
Exactly.
And if he does it, and for the next 7 years pays me the 10% rate of return, I'm making a nice little chunk of change.
Yeah, you're making, there's a good thing called the mortgage. Use the U.S. Mortgage Calculator app. That's what I used it. I originated every single deal, the numbers, everything, right? I use a mortgage calculator app. You can find one on your phone. You're making $763.65. So $763.65 per month is what you're getting paid on that loan, off that loan, right? And if you look at over the length of the term, if they pay you for the whole 7 years, don't pay you off early, your total amount that you would get is $68,147.
So I buy it for 40, and in 7 years, I get back $68,000 and change.
So you just made $28,000 over 7 years.
Which no savings accounts are doing for people.
No.
A lot of 401ks and IRAs and mutual funds are not performing that way either. You're in first position, meaning you're the bank. You're the first mortgage on there. It means you're protected that if they don't pay you, you can foreclose and take this property. So your money's protected by the house, the asset.
It's secured. It's secured.
Yeah, it's secured. You're not
stock's
gambling.
not secured.
It's not Bitcoin.
Your 401k. I like Bitcoin. But no, it's not Bitcoin. Bitcoin's down today. Jeez, it hurt me today. But it goes back up by the dip. But listen, a lot of 401ks were wiped out, right? People had a ton of money in them. They were wiped out. So even right now, one thing that I've been doing for years is I've been having, clients turn their 401k into a self-directed IRA, use that self-directed IRA to buy these real estate notes. And well, that's a whole other topic we'll get into, but that is one thing that we've been doing a lot, in my business too. And you can do it anywhere. You can be in Texas and buy a house in Michigan because you're buying the real estate mortgage note. So the key is you don't have to take care of taxes, insurance, landscaping, plumbing, leaky showers, for nothing. You're just sitting at home getting your principal and interest per month. Yeah. Just like Chase Mortgage.
Yeah, your Chase, your Wells Fargo, your Bank of America. Now, two things that you said right there that honestly is money in the bank. From a wholesale perspective, if you're a wholesaler listening to this show and you're sitting there asking yourself the question, why would I go and do all those extra steps? Well, number one, you now sold this deal for $40,000 instead of $26,000, and you pay that person $18,000, your spread is even bigger. You could have sold this at $35,000 to the note holder and still made more money.
Because believe me, you're not going to get $40,000 from an investor who's looking to flip that house, right? It only makes sense when you find that seller financing end buyer. The numbers increase when you're in seller financing terms because it's not cash right away. Right. So that buyer realizes they have to pay a little bit more money for you holding the note.
And these guys that are wanting these seller financing deals are usually investors that want to buy and hold. They want to be landlords.
Definitely.
And they want to avoid the banking, hurdles. And then aside from that, what you just said, another money in the bank point, is you're opening yourself up to sell that to a lot more people, not just your local investors, because you find the seller financing, sure, that guy's local 9 out of 10 times, or at least, within a few hours is when they're investing. And then you can sell that note to any note buyer across the nation.
Across the country.
Because at the end of the day, as long as the value is there and the interest is there and everything's done legal, I'm in the game.
And how many times do you hear the guy, in California who was afraid to buy in, let's say Maryland, because he doesn't want to deal with property management companies. But when you sell them that they're buying the paper, you're buying the mortgage note, it opens up a lot more. Okay, I just hold the note. So worst case scenario is what? They don't pay me, I foreclose, get the house back, redo it again, the same thing again.
Right.
But I get a house back with value. Right. Again. So,
and if you deal with the right team, you just that's
it's all about the team.
You're dropping fire. if you're dealing with the right team that are going to continue building a relationship with you because they want you to buy more and we want to do more business together. If you get into that situation, you might be thinking, man, I'm listening to the show. I'm in California and I like to get into this, but if it's in Michigan and I buy one of these notes for $30,000, $40,000 and I have to foreclose, what does that mean? I got to figure this out. How do I go over there? This and that. Listen, a great team is going to help you. Number one, we have the attorneys, we have the title companies, we have everyone that's
contractors, if it needs any kind of work, we have all that.
And at the same time, we probably have another buyer that wants the seller financing that will probably come in right away and take that up. So with the right team and the right relationship, you're not going to be left stranded because there are some note buying situations that you can go online and buy a note and you're buying it off a website, for example.
Yeah, you never.
But now, if you don't have relationships in that area, I'm not saying that that's a bad deal because if it's a good deal, it's a good deal. And hopefully nothing happens and the people pay. But if you do it with a team that you're trying to do business with long term, they're going to take care of you. If you're with the right team.
Another thing, a lot of people that buy notes, right? They really don't mind if they get payments for 3-4 years and then the buyer defaults, right? Let's say they got the
heard that. People heard this and they're like, yo, we got to buy these notes. Call it up right now.
Right? Because they want the residual income, right? They just don't want to be a landlord. Right? So you got
most people.
That's most people.
Want to invest in real estate, but the idea, my IT guy was in here yesterday fixing our cloud system and setting it up, and he has one property. And the 2 or 3 calls a year that he gets drives him nuts because he was like, man, I was partying for my mom's birthday and I had a couple drinks on me.
You got a call right
and
there.
I got a call about a leak and I had to go and, get somebody to drive me over there. And when I get there, it was not even a real leak.
Mm-hmm. I mean, think about it. You got
and that drives him up the nut.
It drives him crazy. Yeah.
Plus, he's only making like $200 cash flow per month. So he looks at it like, man, for $200 this month, I had to be inconvenient. However,
hold on. Before you leave that, we didn't talk about that. The note holder is making principal and interest of, what did we say, $607 per month? That's all profit.
700 plus.
Yeah, 7 plus. Yeah, that's all profit, right? As a rental, as a landlord, because of taxes and insurance expenses, your numbers fluctuate. You can really look at this deal and have a fixed number you're going to be at because you're holding paper, you're holding a note. You don't have any expenses besides maybe servicing fees.
Yeah,
right?
You're your own bank.
Right.
But it's funny, look, the mindset, going back to the story, the dude has $100,000 in equity in the property.
Mm-hmm.
So being a landlord and having that property, even if he's making $200, it's paying for itself. He's making $200, and over the last 10 years, it's gone up $100,000.
Oh yeah,
and he's still frustrated,
about the tenants,
about being a landlord or whatnot. And we had the same exact conversation, about, listen, the only other option to still make the money and be involved in real estate is being your own bank. Selling that property, taking that money, and then investing it on basically buying notes.
Mm-hmm. Yep. Because then, the example is, let's say in 3-4 years they made payments, they stop, something happened, lost a job, they default, right? You get the house back. Probably, it might have been in better shape because that homeowner probably fixed it up more. Because again, in this example, this is as is, right? I got a distressed house from a distressed seller. I sold it to an investor in that same distressed condition. That investor probably fixed it up and rented it out to a tenant.
Yeah.
But you got your payments and your down payment, and they was just like, hey, Jorie, we got to do a foreclosure. All right, send the guy out there, give me a number on what it needs as far as repairs, or can we sell it as is? And we have a list of people, who probably buy that same house again, put down a down payment again, and they just start the whole clock again.
And if that still sounds like a headache to you, call us, because through our lending institution, we partner with investors that we then handle that side of it. We partner on the deal together and do everything legal, and we handle the foreclosure process. We lend the money through that, and we set up an investment agreement between us and do everything legit to take care of that if that sounds too much of a headache. But we give you both options.
We do, yeah. Tons of options.
Yeah.
Tons of options. And then, kind of back to this example, because we're going to have way more shows about be your own bank where we break down owning it. But as far as the wholesaler's part right now, the way he's getting paid out of this is that he got the $4,000 down. There's $46,000, right? He's selling it to his note buyer. That's a note buyer who's paying $40 for it. His number is 18. That original seller A, right, agreed to 18, right? So at closing, what happens? The way I do it right now is, my note buyers do not care about my price. They know at closing they're going to pay, my $40,000 price, whatever's in between that 40 and 18 is my assignment fee, right? I get that assignment fee. I walk away. The note buyer, after he closes on me, as far as the wholesale deal, then does the seller financing closing with the end buyer, right? They do that deal. He gets his down payment from that. Then the deal's over.
Title company handles pretty much all of this. Everybody gets there the same day. The note buyer wires the money. They're the bank. Seller signs their half. Buyer signs their half. Everybody gets their money distributed. That mortgage, that loan gets recorded. And now that note buyer becomes their own version of Wells
And another
Fargo.
example too is, there's the 40 from the 18, which is 22. But remember, I'm selling the notes, so that down payment goes to me too, right? We're just selling the whole note together. The note for, what was it, 46,000,
Right.
Right. So the down payment goes to me, the wholesaler.
Right. So you made 4,000 from the guy that made the down payment.
Yep.
And then you made 40
I made 40 minus 18,
gross,
which is 22.
right?
Yeah.
Gross from the guy.
Yep.
So you have a total of 44,000, and then you paid $18,000, and then the difference, what's left over,
That's what we walk away with.
Money in the bank, wholesaling a note.
Hey, thank you once again for listening to Shut Up and Invest. If you guys are motivated at the thought of continuing your real estate journey with us, then visit shutupandinvest.com. There you can join our community and take advantage of more free resources. And don't forget, Please like, comment, and subscribe to this podcast so you're first to hear our new content every week. Most importantly, get active and don't forget to shut up and invest.